think the tariffs fit into a bigger grand strategy for Trump. I think he's a very different guy than Trump 1.0. I think Trump is looking at the 4 years that he has really as sort of a version of a world war, where he's got a grand strategy that he wants to effect. He feels that America is at a crisis point. He wants to get it to the best outcome that he can. He wants to avert the crisis and put America on much better footing for generations. So I think he's really playing for his legacy here. And the reason why that's important is a lot of things that people would normally think a president would be concerned about: a precipitous drop in the stock market, short-term souring relations with key allies, and economic recession. I think for Trump, those things are secondary. He's really trying to remake the American economy and America's position in the world. And so he's willing to take a lot of short-term disruption and pain on the way to get there. In the short term, I think you just got to be super careful. Like in the immediate short term, I think the next couple of days, I don't know when this video is going to go live, but I could see, the next week or so, markets up pretty decidedly, just because things had gotten very oversold with the sell-off before Liberation Day. And then after Liberation Day, we had these just massive sell-offs in the market. So we went from oversold to like crazily oversold. Given the chaos of the Liberation Day tariffs, I think a lot of players then went short to try to take advantage of that. And I think you're going to see a lot of short covering over the next couple of days. But I'm prefacing my coming negativity with saying, hey, I think the markets could do pretty well in the very short term here. I don't think we're through, the uncertainty and chaos of this administration. And maybe in a minute, we can talk about the risk of recession this year, which I think is high. And I think the tariff turmoil that we've had has been, kind of like somebody already sort of teetering on the cliff. And that was probably the shove. We know that a lot of CEOs have been reporting that they are reducing, freezing orders, they're reducing their CapEx. All those things are going to have knock-on effects no matter what happens in the next couple of days or weeks with tariffs here. But there are a whole bunch of reasons to be concerned about a coming recession even before the tariff tempest stirred the soup here. So in general, I kind of encourage people who are trying to make it through 2025 alive to be defensive. I mean, there's the low-hanging fruit of, stay in T-bills, stay in hard assets that could benefit from, a safety trade or just some of the other big trends that are going on. Gold is at the top of that list and should be no surprise. It's been performing awesome this year. What could hopefully be happening here is, if we see continued market turmoil from here, is that we start having better valuations creep into the mix. Valuations were ridiculously distorted at the beginning of this year. By some metrics, the highest they'd ever been. And, you want to buy low, sell high. You want to buy when things are at good value and sell when they're at stretched values. We haven't seen good values in many assets for a long, long time. All of a sudden, you can argue there are some good values beginning to emerge in some stocks here. Even the ones that had done crazy, like a lot of the Mag 7 stocks, they were getting down to a PE ratio that was pretty much in line with the major market indices. Now, I could sure argue some of them might still be overvalued or whatnot, but they were a lot better values than they were before. If we go into recession this year and we have continued market volatility, and if we still have, more correction to the downside, which I believe we do, we may get to a point later on this year where we get into true bear market territory, and you get to a point where investors are starting to kind of give up on great companies. And so, a whole big part of being defensive is having that dry capital to deploy, when the real good values surface. And if you're able to buy good values, then the potential of a resurgence in American economic growth, on top of that, there could be a really optimistic era lying ahead of us here for investors. I don't know we're close to it yet. I don't want to be too Pollyannish about it, but I just mentioned that because I think my advice might be boring here in the near term about where to park your capital. I feel like we could be 9 months to 2 years away from a moment where I might say, geez, this is the point to start getting that dry capital deployed. And you might be setting yourself up for several years of just phenomenal returns by being able to buy great brands, great companies at deep discounts. So anyways, in terms of any other places to be looking at here, there are still pretty good valuations in the commodity space. A lot of the producers have gotten pretty hammered actually over the past month. One sector that keeps coming up a lot with the folks I talk to are the midstream enterprise companies in the energy space. There's some really good producers there that kick off great dividends that had been hanging in there pretty well that have sold off recently. And I don't have any particular names to mention because I don't follow that space super closely myself, but a number of the folks I've talked to have brought that up enough that I think it's worth mentioning here. And then, internationally, it's been rough. There were a lot of guys who are internationally focused who I was interviewing earlier this year who were saying, hey, this looks like it actually could could be the year where there's a rotation away from the US to emerging markets. And we started to see that earlier this year. Of course, that's gotten kind of all upended by the whole tariff thing here. But one bright spot in there has been India. A lot of growth potential. That country is going to grow so fast. The trade decisions are going to be immaterial. So if you're looking to look outside of the US, India seems to be one of the best bets out there right now. But also in terms of, kind of like China, which is graduating, way more PhDs than America is these days. You're getting a large and fast growing educated base there. So using our Vietnam analogy, it's not a country that just makes t-shirts, right? They're taking on higher and higher order level products that they're able to produce there. So just looking at the returns of the companies and the openness of that market relative to China, there's one stat I'm trying to remember, but it was Saudi Arabia, Brazil, and India, their share of global GDP right now versus the EU, or at least in 2018. You'll see by 2033, those three countries will have exceeded the EU. That just shows you the scope of how fast these economies are growing. Yeah. DOGE is basically looking to try to cut fiscal spending, right? So we've had historically high fiscal spending over the past administration such that we're spending at crisis levels, right? The only time we've had the deficit is this type of percentage of GDP, and we've been like in a world war. And so a lot of research that shows that deficit spending boosts corporate profits. So we've had these 2 great years in the stock market, right? 20% plus beats year after year in 23 and 24. But a lot of that prosperity wasn't really real. It was artificial. It was juiced by this deficit spending. Now that we're trying to get the deficit spending under control, to the extent we succeed to that by any measure, that is going to be slowing economic growth. It's going to be depressing corporate profits. And trillion in cuts, kind of through all the different DOGE and other things that are going on is not unlikely. And $6 trillion deficit right now. So if you remove that trillion from 6 trillion, it's a pretty marked decrease that'll trigger a recession. Now you take all the other uncertainty that we had on top of that from the tariffs and whatnot, with CEOs tightening their belts and not sure, what they should be committing. So they're just going to sit and wait. They're going to reduce their CapEx. That's a multiplier on that, right? So the risk of recession begins to get pretty high. And, Diamond talks to captains of industry all day long. But even he said, at this point, my defaults were going into recession. Now, he doesn't think it's going to be terrible. He's saying, look, folks, this isn't going to be a 2008 style crisis. It's going to be more of a garden variety recession, but it's going to be a recession. What's interesting about recession risk is we could have talked at the beginning of the year, and I would have given you a long list of things that I think, were likely to potentially cause recession in 2025. It's clear we're seeing the consumer increasingly struggle. We're seeing retail sales flatline, maybe even go down a bit on a real adjusted basis. We've got liquidity that's starting to drain from the system above and beyond the administration's attempts to curtail the fiscal deficit. There's a lot of things that were tailwinds that are now shifting to become headwinds. But in addition to that, we have DOGE, as we talked about, and we have the tariff uncertainty. But there's another thing that's really interesting that really just kind of got put on my radar last week by Anna Wong. She's the chief economist at Bloomberg Economics. And what she's been hearing in the industry is, the consumers are starting to struggle a bit. We're seeing their delinquencies rise. We're hearing anecdotally they're having a tougher time. But hey, don't forget, unemployment's still quite low, so they're doing fine. And secondly, if we look at their credit scores, they're substantially better than they were back at the start of 2008, right? So they're not nearly as vulnerable as they were credit score wise as they were right before we went into the GFC. And Anna looks at that and she says, you know what, actually, but there's just like in academia where there's been grade inflation, what used to get you a B now gets you an A. There's been a similar effect going on like that in the credit score industry. And so when you kind of discount it back to get to like kind of a real credit score, she says they're actually not that different from when you compare them on that sort of real basis compared to the beginning of 2008. And what she's saying is she doesn't think that the lending industry fully appreciates that yet, is fully aware of that. And so what happens there is you get information asymmetry, where the borrower, the consumer, they've got a much better sense of their true creditworthiness, right? And if it's deteriorating, they're like, well, I'm going to go out and I'm going to try to borrow as much as I can while I still can, right? And the lenders are happy to lend it to them because these folks, quote unquote, have a good credit score, right? So as the delinquencies and defaults really start ramping up and the creditors realize, oh my gosh, the consumer is actually not nearly as healthy as we thought, they're going to start tightening lending standards, right? Mm-hmm. So you're going to get consumers that are going to start drowning under the increased debt loads they have. They're not going to be able to get new debt. And if the economy is slowing in that time frame, that's going to constrict consumer spending. That's going to roll back into meaning less corporate profits. Companies are going to have to tighten even further, start laying people off, and you begin to fall into that vicious cycle. So what's interesting about this whole credit score thing, it's yet another material recession risk that wasn't really even clearly on my radar until a week ago. So there's a whole soup of things that I think suggest that America will be lucky to avoid falling into a recession at some point this year. So the big message that I've been trying to turn on in people's heads here is look, I could be wrong. I hope I'm wrong. But if for all the reasons that you and I have talked about do prove out and America does go into a recession, if you work for a paycheck, right? If you're dependent upon an employer for your income, there are steps you can take today to reduce your vulnerability to getting laid off. And there are definitely things that you should do immediately upon getting a pink slip if you find yourself a victim of a layoff.